Estimating bad debt expense. Remember, this is the adjusting journal entry that can be based either on a method for sale, based on sales, or one that's based on accounts receivable. And we estimate bad debts when we're accrual accounting, which is what all corporations use. And again, that's we recognize our revenue when we earn it, and the expenses follow the revenue. Thus, we need to make that adjusting journal entry, which is debit bad debt expense, credit the allowance for doubtful accounts, uncollectible accounts, or bad debts, and the amount is an estimate. Now, the thing to remember also is that we keep our receivables at their net realizable value. And you'll recall that the net realizable value is the accounts receivable balance minus the allowance for doubtful accounts, uncollectible accounts, accounts balance gives you the net realizable value. And remember, that's in the current asset section of the balance sheet. So that's just trying to remind you that receivables are always kept at their net realizable value, or how much cash you really think you're going to get from customers. When I look at bad debts, doubtful accounts, or uncollectible accounts, we don't know which accounts receivable are not going to pay, so we have to estimate them in the year of sale. And in here, we're going to focus on the percentage of sales or the aging of accounts receivable methods to come up with that adjusting journal entry for debit bad debt expense, credit the allowance. Notice that the percentage of sales method is simpler, but the aging, or one that's based on accounts receivable, is much more accurate. Also, that under IFRS, comparable methods are used. So let's first turn to the percentage of sales method. Under the percentage of sales method, we just take the sales, whether those are total sales or net sales. And remember, net sales is sales minus sales returns and allowances minus sales or cash discounts gives us net sales. So we want to make sure what the problem says. So when you do your homework, make sure you read whether it's total sales or net sales, that you're going to take that percentage that will be given times that amount to come up with the bad debt expense. This is called the income statement approach because notice we're focusing in on the revenue account for what the bad debts are. And after making the entry, we then figure out what the ending balance is in the allowance account. So here's a problem. And notice that we started business on January 1 of 2014. They give us sales information, accounts receivable information, actual write-offs, and also the amount of the adjusting journal entry is going to be 2% of gross sales. So let's look at the accounts and how they get reconstructed. I'm going to get a different color. So first off, the beginning balance is 0 in 2014 because it was a brand new company. During the year, we increased accounts receivable because we had sales of 1.5 million. We had write-offs of $10,000. And we had an ending balance of 650,000. Because they gave us those numbers, we could back into how much cash was collected if we wanted to. Also, we know that the beginning balance in the allowance account was 0 because it was a brand new company. We wrote off 10,000, and our adjusting journal entry for the year which was debit bad debt expense credit allowance for 30,000, came because we took 2% of gross sales to get the adjusting journal entry amount, or $30,000. So we ended up with an ending balance in the allowance of 20,000 at the end of 2014. In 2015, we had sales of 1.4 million and we had write-offs of 22,000, and we are told that our ending balance is 600,000. So again, I could figure out how much cash I collected from customers that year if I wanted. The adjusting journal entry is going to be 2% of gross sales, or $28,000. So again, I make the debit to bad debt expense, the credit to the allowance account for $28,000 as the adjusting entry. And so I end up with a $26,000 credit balance in the allowance account, which means, am I good at figuring out my estimate of bad debts? And so far, so good. I estimated in the first year 30,000 were going to be go bad, and so far in the first and second year 32,000 have gone bad. So it appears that I'm doing a pretty good job of estimating those bad debts. Let's now turn to the aging method.